All right, I think we'll go ahead and get started. Today is January 31st, 2017, and this is SMB's OptionsTribe meeting. The session is being recorded, as are all OptionsTribe meetings. I would like to point out that SMB Training is not a broker-dealer. We're doing these webinars for educational purposes only. Today's webinar does not contain any live or actual live trades. Rather, they are hypothetical. And the issue with hypothetical computer simulated trades and results and so forth are that they're not subject to the market factors of liquidity, slippage, and commissions. So please be aware of that when you review the material today. Options trading is risky, and as a result of that, you should be aware of the risks of options trading. Your online broker has a document which explains those risks. If you decide to go ahead and accept those risks, the next thing you should do is to backtest and paper trade extensively until you feel you have an understanding of options trading, and only then should you expose any of your capital to options trading. If you keep your capital very small when you first start trading, and by first I mean maybe a year or two, keep your capital very, very small, then you'll get the hang of it. You'll get exposed to lots of different kinds of market conditions, and you'll see how options react to those market conditions. If you jump in with a huge amount of capital initially, you're making a very large mistake. I would say that with 100% confidence. So please be careful when you're trading options. The purpose of the OptionsTribe is to bring top-flight options experts to the table, I should say, every week, Tuesday at 4:30, and today is no exception. We have Ron Bertino, who is making his debut appearance on the OptionsTribe to discuss his now famous spaceship trade. So, Ron, welcome to the OptionsTribe.
Thanks, Seth. Good to be here.
Yes, and it's very good to have you. We've been hearing a lot about the spaceship trade lately, and there's a lot of buzz about it. And I thought it'd be a great idea to get you onto the OptionsTribe so you could explain the purpose of the trade, how it works, etc., to all of our members.
Sure.
So, with that, Ron, what I'm going to do, and I'd like to point out to everybody. It's a lot of work to do, a tremendous amount of work to prepare for an OptionsTribe meeting, and people may not appreciate how much effort goes into really clearly explaining and teaching something. So I want you to all know that Ron went through quite an extensive production to put this together today, so I'm sure you will all get a lot out of it. Now, Ron, I'm going to give you your presenter mode, and I want to remind you that there's a chat and a Q&A. I'm going to keep an eye on those for you.
Sure.
So all you've got to do is present, and the one question I do have is whether you would like folks to type their questions in and then have them held until the end of the session, or do you like taking questions while you're presenting?
Okay, normally I'm perfectly fine taking questions as we go, but since we've got a fairly limited amount of time and my objective here is to try and give you something tangible and that you can actually use by the end of the session, I'd like to try and get through the content first and then do the questions at the end, if that's okay.
Okay, that's great. Then I'm going to ask everyone to please type your questions in. We'll be aware of them, but we're going to be putting them forth at the end of the session. So, Ron, with that, I think you can go ahead and fire away.
All right, perfect. All right, hi everyone. So I'm Ron Bertino. I'm basically, here for the first time. I've been around this community for quite a while now, so it's good to basically be on as a presenter here. So today we're going to look at this space trip trade. This variation that you see here was actually my very first incarnation of this particular trade, and it was created in a way that is perhaps a little bit different in the sense that it was created to be a hedge to my at-the-money structures, right? So, and I've traded pretty much all of them, right? So the M3s, the road trip, the Rhino, the wet Rhino, all of the variations that are out there in the community, I've pretty much traded. And the feeling that I had was and I guess it's a decision that I made a while ago, which is that I want to make sure that I can do a trade, but whatever it is that I'm going to do, I wanted to make sure that I could scale, right? Because obviously, as you look ahead, you want to make sure that you can, trade larger. Of course, doing that in a safe way, as Seth has mentioned. But I'm kind of looking down the road that you may end up one day trading for hedge funds and all that kind of thing. So obviously, I wanted things to be able to scale, right? So in order to do that, I kind of came to the decision that I needed to approach things perhaps a little bit backwards to the way that most people do it, in that instead of focusing on the at-the-money structure first, and then as almost like an afterthought, you go, oh, gee, well, maybe I should hedge. I thought, well, no, let's come at that backwards. Let's get good at knowing how to hedge first, and then once we get good at that, then we can scale up the at-the-money structures, of which I've got tons to choose from, but there's very little choice in terms of good hedges, right? So if I could focus on that, then the two things could be paired nicely, and then that would allow me to scale up. Okay, so, and again, this is the first incarnation of how that was born, and we'll get through to how it evolved as we go. So, all right, let's get stuck into it. Now, we've gone through the disclaimer, so I don't really need to touch on that again, so we'll keep going. So a very, very quick little intro, which I know I get a feeling most of you probably know who I am, but for those of you that don't, I grew up in Australia, so I landed the Kangaroos and Sydney Harbour Bridge and the Opera House, as you can see here. So a couple of little tips for you. If you ever do go through to Australia, you can actually climb this guy here, and you can kind of walk like this and go all the way up on top of the bridge, which is well worth doing. And on the left, even though these guys look beautiful, they look like little dogs with long legs. Never get close to them, because with these claws that these guys have, they can literally slice you in two. So bit of a tip. All right.
I mean, do you really see them? Do you see them frequently, or is that a myth?
Actually, you do. It depends where you go. So I've been out through to, sometimes, clients would take you out to do golf or something like that. And, in some golf courses, they're jumping around in the golf course. You don't really see them on the beach. This is, this must be a very remote area here. It's probably the north shore of Australia. But on the heavily populated ones, you don't get kangaroos on the beach, but you definitely get them in the bush. So, I mean, within a 30-minute drive of almost anywhere, you could basically get to the bush and see them. But again, they're they're wild animals, right? So again, their claws are vicious. So you do not get close to these guys.
That's interesting. And you don't see them in any other part of the world other than Australia, is that right?
That's right. They're native to Australia, yeah.
Very interesting. Yep. Okay. But
all right, so graduated as a programmer. From there, moved on to various other things, but I guess one of the things that kind of a little different is I'm also a black belt in Kung Fu. I did this for about 15 years or so. I taught it for about 3 years. Fantastic style. I absolutely love this particular style. I trained in a whole variety of styles, but this one was my favorite. I did this one for about 10 years, I think. So that was fun. Unfortunately, this style doesn't exist here in the US, but such is life. Training-wise, I started just after the year 2000, after the Y2K bug thing was over. I kind of got into trading, got in through to stocks, as I guess most people do from a directional perspective. Found my way drifting in through to day trading, and then drifted out of it, right? I found that I kind of chained myself to the computer, and I was like an addict. I had to be on my computer all the time, and started affecting my family life in not so good ways. So then took a bit of a break, and then came back to it and started doing option trading, still with a directional focus, but then later on moved on through to the delta neutral trades. And I've been with other communities such as the Sheridan Mentoring, Capital Discussions, OptionsTribe, obviously, and so forth. So I've been around the block for a while. Professionally, I graduated as a programmer, but I basically moved into what's called systems engineering, which is kind of almost all the infrastructure that runs the world these days, right? Everything from clusters to storage, through to networking, through to security, email, databases, clusters, all that kind of stuff. So these days I architect those styles of solutions. I don't actually deploy them anymore. I handball that off to other guys to do the hard work. My job is to basically architect to the largest companies in the world, and I've been doing that for quite a while. And aside from that, I also run Trading Dominion, And this is essentially another trading community, which I hope is going to be a very popular one as time goes by and offers a lot of value for everyone. Okay, so let's get into this. Now, I've given you a bit of a run through already as to the thinking, right, of how this trade was born. So again, another thing that I haven't mentioned yet is one of the, we all know that portfolio margin is out there. We know that span margin is out there. Most people just think of that as a way to get leverage. Now that's true, it is a way to get leverage, but I found it frustrating that there was basically no content almost anywhere out there that taught you how to properly leverage span or portfolio margin, not just to be able to get leverage, right? In order to be able to use its power, but for safety, believe it or not just for getting bigger bang for bucks, right? So since it wasn't out there, I pretty much had to explore it on my own and come up with things, which made it a little bit more tricky, but I feel that that's more or less done now. So that was one thing. So these trades are definitely built to take advantage and leverage portfolio or span margin. I should, since we're here, I should say, portfolio margin with TD Ameritrade, basically this requires 125K, 125K to start off with, and you can't drop below 100K, so you do need a decent amount of capital. For span margin though, you can actually have Reg T and still leverage span margin by trading futures options. So as long as you're approved to trade the E-mini, S&P as an example, the /ES, then you're good to go with span margin there, right? Even though you've got a Reg T account. So don't think that this may not apply to you because you don't have portfolio margin, right? It does. But if you do have portfolio margin, you basically want to shift right from span to portfolio because you will save on commissions, and liquidity to a degree is better too. Now, I've mentioned this concept here of wanting to do something that will scale. If it doesn't have the capability or capacity to scale, I will not bother with looking at it. I wanted something that could withstand a highly volatile market and was bearish leaning. Obviously, it has to be bearish leaning if it's going to be a hedge. And like I explained before, I wanted a way to hedge, but again thought that there had to be a better way than this. What typically people do, they call it teenies, right? But this is buying, far out of the money puts, which are cheap. The thing about that though is that obviously these things are theta negative, right? Which means it gets worse with time, and they get weaker as time goes by, right? Well, I wanted to try to find a hedge that did the opposite. So I wanted something that was essentially theta positive and actually gets stronger with time, not weaker, right? And that's how this trade was born, right? By trying to marry this concept here with the concept of, with the concept of a hedge, right? With the concept of span margin leverage as well. Okay, and like I said, then this would give you the peace of mind of knowing that since you are nicely hedged to the downside, you could basically start scaling up your at-the-money structures at an equivalent level and just keep going, right? Because you can then scale up as large as you're comfortable doing that, and you know that you're essentially covered with your downside hedging, once you know how to do it, of course, right? And the last thing here is, I say free, of course I say that jokingly, right? Nothing is free, but I wanted it to be as close to free as possible. All right, and you'll see that once we get to the tail end of this presentation where I talk about harvesting, you can actually end up with what is literally a free trade at that point. You're now trading with purely the market's money, and there's no way that you can lose at that point once it's morphed, right? Of course, there's always a way you can lose from day one, but once you've morphed and locked in the trade, as you'll see at the end, then it literally does morph in through to being the market's money. Now, there are, you'll basically see that one of the things that I've done is I've tried to have a massive brain dump of, all these things that I've learned through the last, 10, 15 years of trading and what have you. And I put all this into a course, and which, we'll talk about at the end. But basically, this trade is also built upon certain specific foundations, right? And what I'm getting at is that when you trade, you really want to make sure that you've got some kind of edge in your trade. I know that Andrew Faldi talks about this as well, right? And I fully agree with him, right? You have to know what your edge is, and you need to be able to exploit something in order to make that viable, I think, right? So with the trades that I do, I make sure that there's solid edge in them based on options theory. Okay, and this here is one of the key concepts, and we'll actually cover two. There's a ton of concepts that I cover in my course, but I've only got time to cover two, but they're pretty important. I think this is something that can be used by you guys immediately, hopefully by the end of today, right? So what this is showing, if you haven't seen this before, this is Thinkorswim basically showing you the extrinsic value of options for two particular expirations on the put side, right? So what's going on here is that you can see that we've got the March expiration over here in cyan, and we've got a June expiration here in magenta, right? Now this screenshot's a little bit old. These aren't, June and March of 2017, but it doesn't matter. What matters is that if you start, so if we're basically at the money is right here, right? So if we start here and then we go through time, right? So we basically go from 143 DTE down to 52 DTE. What's going to occur is that the extrinsic value of an at-the-money option, ignoring everything else, of course, right? Ignoring IV, ignoring price movement and so forth, purely looking at this one variable, this is going to drop down through to here, okay? And what's happening is that as we go this way on this axis, this is basically going out of the money on the put side, okay? And the key thing to realize is that if you, and over here I'm going through to these two deltas, right? And this is specific. You'll see why when we'll get through to the trade. Essentially, we're basically setting up put credit spreads here and put debit spreads there, as you'll see a little bit later on. But basically, what we're trying to leverage is the fact that if you look at this and then you compare it through to this on a percentage basis, right? What's going to occur is that the further out of the money you go, it will decay faster than closer to the money options on a percentage basis, okay? On a nominal basis, it's different, but on a percentage basis, it's absolutely consistent all the time, right? And this right here is part of what we are trying to leverage. So in other words, the thinking here is saying, well, sure, we could basically do like a butterfly type structure, right? But by doing this, these wings are very, very tight. They're very close together. So the thinking behind this particular trade is saying, well, if we know that the further out of the money options are going to decay faster on a percentage basis, why don't we split those wings out, right? Because if you think about a put credit spread, would you be happy that the put credit spread decays quickly? Heck yeah. That's exactly what you want, right? Do you want the put debit spread to decay quickly? No, you want this. This is for a downside hedge. The put debit spread over here should basically try and retain its value, and the put credit spread, you want this guy to quickly dissipate, right, in value. And that is exactly what we're leveraging with the fact that further out of the money options are decaying faster on a percentage basis. Okie doke. So that is one of the key concepts behind this particular trade. So let's have a look at the trade setup. So now most of you are probably used to trading structures, which are at the money. And when you're doing that, you're typically, at the 56 DTEs, or sometimes closer, and that's fine. So when you see something like 90 DTE, you might go, oh my gosh, that's so far away, right? Well, it is, but again, it's different, right? And there's a good reason why we actually go that far out. And notice that I've said or higher, right? I have gone out beyond, well, the furthest that I typically may go out through to is about 1 year out, believe it or not, right? With the same structure, okay? Now, that being said, even though you absolutely can go all the way out to a year, what I've found just through, backtesting and live trading and so forth, is that at least my personal preference is a sweet spot between 90 and 120 DTE. But again, you can go way out here through to up to like a year. I wouldn't suggest going beyond that, right? But play with all of these and see which ones you like, right? Even though this may sound crazy to you, you'll see how it applies when we get through to the layering concept at the end. So roughly 90 DTE. This is a negative Vega trade, so therefore, basically, if you get an IV spike, then that is a pretty nice time to enter one of these trades. In terms of placement for the put credit spread, we're going to be doing a 25 wide put credit spread for $1. Okay, that's how we find where that's going to be placed. I like to stick through to the 25 multiples, and roughly speaking, you can start hunting at around a -6 delta. and that's where you'll typically find the $1 credit for the 25 wide. Right? So that's that one. Then for the put debit spread, we basically go out one standard deviation. That's going to be roughly somewhere around 16 delta, if that's how you like to find it. And then from there again, 25 multiples and 25 wide. Right? Last one is basically we are going to start off with this thing being slightly negative delta, so about -1 to -3. I'm using toss volatility smile, which we can kind of talk about in a little bit. And we also want the T0 line to basically cross behind our uppermost long put. All right, which we'll
Ron,
get
what
to.
are you calling a tranche? When you say one tranche, is it
Right.
4 debit spreads and 10?
Yeah, 10 credit spreads back here, and then
Yeah.
the put debit spreads typically will be at a factor of about 4.
That one tranche should have no more than -1 to -3 deltas per tranche.
It will be roughly that, yeah.
Okay.
So
It will be
basically
roughly that
slightly
at
negative per tranche. Correct.
inception. Okay.
Yeah.
All right.
All right. So let's keep going. Now, from an execution perspective, obviously this thing is going to be an iron condor. Sorry, not an iron condor, a standard condor. So you can try to fill that as a condor, and that's perfectly fine. And I've had many fill that way. But it sometimes, obviously you may not get filled. If that's the case, you can split that order in through 2 put credit spreads and put debit spreads and just throw it in via verticals, right? And I've done plenty of both of those. So this is basically what it looks like, right? So again, the last one was just like a reference slide that you can look at, but visually, these are the steps. So the first thing that we're going to do is we're basically going to be setting up the back wing here. And what we're doing is we're going through to an expiration, which is roughly about 90 days. Again, this is not a current day screenshot, so don't ignore this. So this is basically something roughly 90 to 120 DTE. We're going to be looking for a $1 credit for that 25 wide. Okay, and then that is going to be setting up this back wing. So that's step 1. Step 2 here is we now want to do the put debit spread. The put debit spread, if you set this date in thinkorswim through to whatever the expiration is, this band here is what's going to define the 1 standard deviation move, right? So you basically want to set up the put debit spread somewhere around there. There's no rule that says that one has to be in, one has to be out. It could be back here. They could both be slightly inside. The point is that it's just roughly at about 1 standard deviation, right? Normally, you'll always be doing 10 of these. You'll normally be doing 4 of these, roughly. Okay, but I'll show you how to find that balance point. But that's a pretty good estimation. And then what we want to do is we want to look at, in my display, this is where the at the money prices, which is this line here. And I can see that the delta is slightly negative. I know that's a bit small, but that says -1.82. All right, so we are slightly leaning down, all right, from at the money. This is using toss volatility smile. So that's step 3. Step 4 here is to look at the cross point of the T0 with the 0 line. And ideally, I like this cross point to be somewhere from here, from the upper long. So in other words, where the structure starts, I want that cross point to happen here or slightly further back. Okay? And 5, the last step here is to basically look at your starting debit, right, which is basically where your upper expiration line is, and you compare that through to, in this case, what the lower expiration line is here, or you may call it the max reg T risk, right? So you're basically saying, all right, well, what is this? And in this case, it's 190. So we're dividing that by 15,000, and that comes through to 1.3%, right? Our debit is 1.3% of our lower expiration line here. So the rough guideline is that this should be roughly about 2% or so. Obviously, the smaller it is, the better. I do not like going beyond 5. If it's 5 or more, I dismiss that as a trade, right? I look for something else. I may choose a different expiration or something like that. So that right there are the 5 steps that you go through to set up the trade, okay? And you can see that there's a law of distance over here, okay? And our upside risk, assuming we do nothing, is really just $190 in this case, right? Now, you recall that I mentioned that I wanted something that would leverage portfolio margin and span margin, right? So although we're in a scenario here where we've got the $15,000 of max risk, this is rate T, right? So when we're looking at portfolio margin, if you're not used to seeing it, the margin requirement is this guy here, and that middle number right there is the portfolio margin required for this trade, right? So even though this has, from a Reg T perspective, $15,000 worth of Reg T risk, from a portfolio margin perspective, it's only $1,000. Okay, so you're getting significant leverage from PM by doing a trade like this, right? And if you haven't done it before, a rough kind of guideline to look for is this line here that you see, this dotted line, is roughly minus 12% down. Okay, roughly speaking, what your T plus 0 is at minus 12% down is going to be what your portfolio margin is going to be, roughly speaking. Okay, in this case, obviously it's above 0, so it's not a perfect match, but it's not a bad guideline if you're just trying to ballpark what the PM would actually be. All right, so that's the setup. Now, the nice thing about this is how does it evolve? So as time goes by, what's going to occur is that you get this really nice profit hump here, right? And remember, this was essentially like a 90-day trade, and 1/3 after, so in other words, 30 days have gone by, and after 30 days, we've got this beautiful profit hump over here that's essentially hedging, whatever kind of trade we might be doing here for at the money. It's now providing a nice cushion for let's call it roughly, remember this here is 12% down, right? So that's, quite a cushion, right? But roughly speaking, this trade is designed to basically absorb, your 5 to 10% move down that, these trades over here may struggle a little bit with, right? In the course, I actually teach another thing over here, which I call a black swan hedge, which basically grabs your T0 here and basically hooks it back up, okay? And this is to protect against the black swan hedge. So this is like, the 1987, the August 2015, right? We're talking, significant moves down with big spikes in IV. That's what our black swan hedge does. It basically protects our space strip trades, right? And on top of that, I've now got six different variants of STTs, which are income STTs, not hedges, right? But this style here is the hedge, and that's what we're talking about today, so we'll stick with that. So,
Ron, so are you saying the Condor structure itself is 10 to 12% out of the money?
Yeah, so if you look down here, you can see that this is minus 12% for the price slice, and this dotted line here is minus 12%. Now, this here is one standard deviation, right? So look at it however you like, but basically the structure is one standard deviation out at expiration.
I see.
Right.
Okay.
So that's what it looks like after 30 days. After 60 days, it looks even better, right? So we've now got this nice big profit hump over here that's hedging whatever at the money style structures we're actually doing. Okay, so again, the concept of what's actually happening here is, remember, our back wing is decaying at a faster rate than this wing. All right, and since that happens, this line lifts up higher and higher. Okay. All right, now road trip versus space trip. Now there's another trade out in the community called road trip. I'm not going to go into that, but I know it's a popular trade. I could have chosen anything, right? The M3, whatever. I have a whole variety of different broken wings, but one of the key things here that I want to highlight is a slight difference between the trade types, right? But then I want to show you how powerful it can be to actually combine the spaceship trades with whatever structure you're actually doing, such as the road trip, like here, right? But again, it could be M3, it could be whatever you like, right? So here in this case, when you start off with a standard road trip style structure, you'll typically be starting slightly positive delta, okay? Assuming you don't kind of tweak the strikes, right? Just the standard setup. Then here you can see that the theta here is 17.61, okay? With a standard setup here, a 6 lot. Okay, and the PM for this particular trade is $3,000, as you can see here, right? Now, a move down through to here, through to 1800, you can basically see that it would be roughly a $500 loss. It's not 353, by the way, if you're looking at that. The reason for that is because what's happening is that this is toss fall smile, and here, when we're starting off, Toast Smile is basically thinking that you're up $179. You're not. You're starting from zero. But the line can kind of dance up and down based on the modeling, right? So the real loss here would be 353, as well as this number here, which you would have started on 179. Now you're down at 353. Therefore, you're actually down roughly about $500 from where you started. Okay. And similarly, if we were to get a move down, of course, I'm keeping things simple, right? I know IV would spike, blah, 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 right? Just keeping it simple. If we look at where the T0 is here, it's at a loss of minus 3K. Again, I'm fully aware that's not realistic. IV would basically push this thing down further, right? But let's just keep it simple to compare. So now if we do a 3 tranche STT here, we can see that the theta is the same. So that's why I chose 3 tranches, just so we'd have an equivalent, a theta equivalent comparison. And what's interesting as well is that it's more or less the same PM, the same portfolio margin. Okay, so a 6-lot road trip is essentially fairly similar through to a 3 tranche STT. Right? And when we're looking at that, we're basically saying, well, all right, that's good. Well, if we move down through to 1800 on day 0, again, without IV changes, we're actually up some money, right? We're about $280 up. And if we move 12% down over here, we're basically still fine, right? We're basically still there. Because again, we have such a long ramp on the way down. All right, again, ignoring IV in this case. But again, the point is that we can look to potentially combine these things. If we look at the road trip and we say, all right, that looks fine from day 1, but what happens once this thing starts to evolve through time, right? So in other words, time goes by. Well, we start getting that profit hump that we want with our income trades, right? And you can see here that from here through to there, we basically have a profit range, if you want to call it that, of roughly 250 points. Now, if we compare that through to the space trip trade, and we then see what happens after 30 days, well, we can now see that the profit range is a lot wider. It's 370 points, right? But it's on the way down, right? If you recall, the road trip trade was roughly from here to about there, right? So it doesn't take a brain surgeon to figure out, well, if the road trip trade is basically going to make money in this range here, and the space trip trade is going to make in this range over here, why don't we combine them, right? So if you were to do that, and the rough way to size these things, in simple terms, at least it is with road trip trades. As a matter of fact, I actually tested this out with M3s as well. It was more or less equivalent. The way to figure out how many tranches you want to do for STTs compared to your at the money is to roughly keep the roof height the same. Okay? Nice and easy kind of way to size there. But if I do 3 STTs and a standard 6-lot tranche of the road trip, you can see here that now that my starting delta overall for the combined trade is -1. So that's nice because I've basically flattened out. If you recall before, this was actually at +3, right? So we start off flat. We don't have to do anything weird of splitting strikes or anything like that, right? We simply balance out the deltas with the fact that we're combining it with an STT. But now if we basically start going out through to 30 days, look at this, right? We now have basically a profit range from, actually there's the line there, from here all the way to here. That's a huge range, right? And that's after 30 days. Right? What happens if we keep going? Oh, I don't have that screenshot. If we keep going, basically this hump keeps building up as we go, like that, right? Because again, this swing here is decaying faster than that wing there, so that's lifting up our T0. Okay, and I've got a few of my customers that have told me that they were doing exactly this just before Brexit, as a matter of fact, right? So they were trading road trips. They entered 6 days before, one guy anyway that was telling me he had road trips on 6 days before Brexit, and fortunately he had just seen my space trip trade presentation, this same one, right? And he actually put on a couple of these guys, and thanks to having these guys over here, basically he ended up making money through the move down rather than losing it, which he would have lost had he just had the road trips on. Okay, and kind of marrying this on through to kind of a little joking little term that I have here is I've got this thing I call the 3 amigos, right? And what the 3 amigos are is basically we add one more module to this. It's kind of like a 3-step train, right? So you've got whatever at the money structure you're happy with, right? It might be road trip, might be M3, whatever. Then you've got the STT back here. The STT is again providing hedging for that kind of 5 to 10% move down, right? And again, this gets stronger and stronger as time goes by. And then back here, as a matter of fact, I'd have to probably draw it back here, right? Back here, we've basically got the black swan hedge, and the black swan hedge again picks this line up, right? So we're essentially covered for all those scenarios. And again, once you have that balance, and I'll show you a risk graph of what I mean by this literally, right? It allows you to basically scale up in what I consider to be a very conservative way, right? Such that you know that if the market does something insane, right, something it's never done, such as gapping overnight by 30%, right, that these black swan hedges over here, they just blow up, right? So in other words, they really pick up the line because they have not just positive vega, but they have what's called positive voma, right, which is a rate of acceleration of your vega, right? It's a second order Greek. And they have lots of that, much stronger than what you can get with teeny type of protection, right? So these three things here work really nicely, hence the joking name of the three amigos, right? So what this slide here is trying to refer to is, well, you can see that we've got a decent kind of profit hump here, right? And you might go, well, clearly it's not going to start that way. Well, it's not. This is actually a trade that's showing you that we have already been in the trade for roughly about 30 days. So we have a nice profit hump. But the concept is saying, what if instead of from day one starting off, let me go back. Instead of on day one starting like this, right, where you're basically starting with the combo of the STT plus, let's say, a road trip or an M3, right? And you might say, well, if on day one, as soon as you put it on, if you start getting a big move down and a big spike in IV, surely this line is going to get pushed down. Sure, that's true, right? Especially if you're not trading with the black swan hedge, right? Because remember, the black swan hedge counters this movement in the other way, right? But we're not talking about this today. So therefore, if you're trading with this, which is essentially still two negative Vega style trades, then sure, right? If you get a big move down, a big spike in IV, the line will pop down. So the concept is saying, well, if that's a concern, then why not kind of start off with the STT first, then wait 30 days. In 30 days, you've now got an existing profit hump. When you have that existing profit hump, then put on your at the money structure, right? At that point, if you then, even when you, as soon as you laid this guy on, if you do get that move down, well, you've got a nice cushion already, right? To basically bank on. So you can absolutely do that first. So you basically let your STTs mature a little bit, and then once you've got a bit of a profit hump, then you start layering in your at the money structures. All right, trade management. So first thing to point out here is that this is not a fully mechanical style trade, right, as many of them are. There is a bit of discretion involved, but this trade is ridiculously hands-off. Okay, you can slap it on and kind of check it once a week. I've got some people that do literally that. Again, I don't think you'll see a more hands-off trade than this one here. And again, feel free to backtest it yourself and validate that for yourself, right? Now, this has a huge tolerance of price movement, as you saw from that graph, right? We had 370 points of movement after, let's say, 30 days. So very forgiving on the downside. Now, if the most conservative way I feel to adjust this to the downside is that if you basically see your deltas go positive, at that point you make a slight tweak in order to keep your deltas slightly negative, right? Remember that as time goes by, you've got a second order Greek called charm that works in your favor. So in other words, you're starting off like this with a little bit of negative delta, right? Then as time goes by, your delta starts getting more and more negative, okay, which is called negative charm. So that helps you, okay, because again, your risk is actually reduced as time goes by. Whereas with teenies, it's the other way around. Teenies start strong on day one and then get weaker day by day, right? With the space trip trade, it's the other way around, right? It's actually positive theta and it gets stronger in terms of downside protection as time goes by, okay? And I should point out, by the way, that I haven't talked about BSH and I don't plan to, but do not underestimate the power of teenies for providing black swan protection. Okay, they really are quite powerful, just following some basic guidelines. Okay, now don't do what I considered something silly like buying 5 or 10 cent out of the money puts, right? They are literally worthless, right? But as a guideline, which feel free to take away as a freebie, don't buy anything worth less than $1 and stick to roughly a 60 to 90 day time frame for buying teenies. Do that, and that alone, that right there is really good black swan protection compared to almost anything else that you see out there. Of course, my black swan hedge is twice as powerful as that for the same cost. And then I show you how to finance it as well. But again, if you don't know the black swan hedge, look to this if you want to do simple but effective black swan protection. Okay. All right. In terms of downside adjustments, you can obviously add a put debit spread on the way down. You could add a new STT tranche on the way down with slightly more negative deltas. So in other words, you're typically going to be doing this style of structure, which has 10 put credit spreads, and on average, it's going to have 4 put debit spreads. If price starts coming down on you and you need to add another layer, you could basically add another layer like this. But what you could do is that in this case, you might buy 5 put debit spreads on this tranche, right? And now what you'll have is that you'll basically have kind of a structure like that, all right, that now has, at the money might be about here. And now you're writing negative deltas on the way down, and you've also expanded the size of your structure, right? In order to say, well, by expiration, I can now land in this entire range potentially and be fine. Okay?
And this can't even occur unless the markets come down 12%.
In terms of,
is that right?
In terms of entering your structure, yeah. On average, yes. Providing that you're going out to, let's say, at least 90 days. Right? Obviously, if you set up these type of structures at 30 days out, you're going to be closer to the money, because it's one standard deviation for 30 days is less than one standard deviation for 90 days. Right?
Right.
Yeah.
Okay.
Right. And you can also potentially roll down the uppermost structure. So you might be in a situation kind of like what I mentioned, right? Some kind of multiple structure tier where you've got, 2 or more of these space strip trades. And if price starts hitting your structure here, what you could do is that you basically grab the uppermost structure, take it off, and then layer it back here. So you simply roll it back, all right? But the nice thing about this is that typically what happens is that as price is hitting that structure, this is actually a money-making endeavor, right? Because remember, your deltas start getting more and more negative as this thing matures. So providing it doesn't happen on day one, right, that it happens after, let's say, a couple weeks on a 90-day trade, then as price basically grinds down and hits your structure, that is, you're taking this thing off for a profit, right? And now since IV is higher by the time that it's hit that structure, now when you roll down that front structure, you not only are locking in those profits, right, which you're cashing in on, but now the structure can be placed further behind the money, even though it's one standard deviation, but the one standard deviation has been pushed out due to IV increasing, right? So you get an even wider range now as well, which is cool. And of course, you could also do traditional things like a bearish butterfly. For this, if you had a structure like this, right, basically you got longs and you got shorts, so you could place a bearish butterfly with your upper longs here, then shorts, then longs. So in other words, it's a butterfly roll of these shorts down, right? If that didn't make sense, basically just layer the butterfly on top of the shorts. So the upper longs of the butterfly is on top of this short here, and just add a butterfly there and stick with that if what I said before sounds confusing. Okay, so multiple ways of adjusting on the way down, but again, it's typically an easy endeavor because, again, you're normally writing negative deltas on the way down and you're actually taking profits. Okay, so a couple of examples here. So we've got, the structure, price moves down on us. Our deltas have basically turned slightly positive, and again, we're still comfortably away from our structure, right? But the conservative thing is to say, well, if for whatever reason our deltas go positive, let's just add another debit spread here, okay? And which you can see what I've done there. I've just added another 25 debit spread on top of this guy, and of course that's going to result in giving us slightly negative deltas. So we're now at -4. Of course, our upper expiration line is going to drop, right? Because we've got to pay for this. It's not free. but it's fine, right? And the nice thing is that as this thing comes down here, if you were to look at your theta distribution, right, the amount of theta that you get here versus the amount of theta that you get here, you're actually getting more theta here, right? So if price comes down and then kind of dances around in here, that's perfectly fine, because now we're in the sweet spot, right, for this trade. The sweet spot is basically just in front of the structure, right? If price dances there, it's awesome, right? You get slightly more and more negative deltas as it goes, and the theta is really juicy. All right. In terms of rolling the structure down, here we basically have a starting structure. We then get price here that has moved down to this middle line. It's getting quite close to our structure, but notice that our T0 is still, very reasonable, right? We're in profit, okay? And so at this point, we basically say, fine. We basically take off the structure from where it was for a profit, roll it back. And like I said before, the fact that IV is now higher implies that our one standard deviation is pushed out, and we can now push out our structure further back and still retain a very flat T0 on the way down. And then at that point, just allow this thing to mature and start building up our profit hump. Right? So they're really quite straightforward to manage. Last thing here is we can add another tranche to rebalance deltas, which is what I was saying before, where we start with a structure like this. We then have the market come against us, right? And then what we're doing here is that we're now adding, so this was the original put debit spread, this was the original put credit spread, right? And now we're adding this guy and this guy as our next tranche, right? So from an order perspective, this would still look like a standard shape. It would still look like these guys, right? But when we combine them, it basically gives you this extended structure. So we still flatten out our deltas, but we widen out our profit tent. Okay? All right, management to the upside. So here, if price moves up on you, you'll find that you're not really putting much at risk, because remember that the example that I showed only had like $190 of risk. Okay? But that being said, if you wanted to manage this thing to the upside, then really what we're doing is we're still following the same criteria. So we're basically saying, well, let's see if we can sell a put credit spread such that we can lift. So if our structure started off like this, okay, but the upper expiration line here started off at, let's say, minus 190, like we had in that prior screenshot, right? So if price decides to shift to the upside, then what we can do is we can basically hunt around for where we could sell a put credit spread for $1. So same criteria as we did for this guy, right? We sold this guy for $1 originally. So we now simply look for where we can sell a put credit spread for $1 and sell that thing there somewhere, right? What that's going to do is that's going to lift this upper expiration line. So our objective is to basically get this thing to 0 plus commissions, right? And at that point, if you want, you can just forget about it. Because if price really does take off, a lot of the time what happens is that it hits some kind of resistance and comes back down, right? By that time, your profit hump would have built up. So now if you get that kind of reversion, your profit hump basically cashes in. If you don't get that reversion and price just keeps on shooting up, who cares? You haven't lost anything, right? Because you've sold a couple of credit spreads to lift that upper expiration line to 0 plus commission, so no risk. Okay. All right, and of course, as I say here, so if you're starting off with that particular structure, could you do other things? Could you roll shorts up? Of course, it's still the same concept. You're still doing a put credit spread. Could you add another tranche higher up? Sure, right? So as price moves up this way, could I not just add another tranche up here? Of course I can, and then that again extends my profit structure up here, right? Lastly, could I say, well, if I have this kind of structure and price moves up, and let's say that I've got some kind of profit hump built up, could I at this point basically put on some style of M3 or M3U or road trip or whatever? Yeah, right? Now if this thing gets in trouble, now I've got this guy behind it protecting it. Okay? So, I've kind of scribbled all over the last slide, but this was what this slide here was for, right? So again, we can do the concepts of selling another put credit spread to lift this line up. We can add another tranche like this as price moves up, okay? Or we could grab our shorts and shift those up, which is still a credit spread adjustment, same kind of stuff, right? The key thing is that we start off here with a very small debit. Our key is that if this doesn't come down here so that we can cash in on the profit hump and it goes the other way, let's simply just do something like sell a credit spread to get rid of this debit and then just let it mature, right? If price comes back down later on, great, we cash in, right? But if it keeps going up, we don't necessarily have much risk at all. Actually, no risk if we get up to zero. So layering, I've already talked briefly about this concept of a price movement layer, right? So again, we've looked at layering on the way down and we've looked at layering on the way up, right? You can do it in both directions. Time layering is another interesting concept, which we probably don't have time to look into today, but it's the concept of getting diversification through time, right? Because if you think about it this way, if you go out through to 90 days and you basically go out and you set up, your standard type structure, if you then go out through to, let's say, 150 days out, right? Well, one standard deviation at 150 days out is going to be further away from the money, right? So if this is at the money here, okay, then on 90 days, the 90-day one standard deviation is this distance, right? Because that's where we're setting up our structure. But if I now go through to 150, one standard deviation for 150 days is probably out here. So now I can set up a structure here, right? So now if you look at this from like a bird's eye view, the further out in time you go, the more of these structures that you can basically layer on like this, okay? So this out here might be, whatever, 200 days, right? So you got one at 200, one at 150, one at 90. And now what happens is that you start getting that profit hump across all of them, okay? And you can have this stair-step style structures dispersed through time, okay? And then again, it's the concept of essentially getting a massive profit hump in terms of distance, all right? I'm not necessarily saying it's going to be super tall, but from a distance perspective, you're getting very, very wide coverage, all right? And that's what I call time layering. All right, so here an example of this price movement style layering, right? So we've got here this is now describing not the profit range of the T0 being above the zero line. It's simply looking at the structure now, okay? So this is saying it's 260 points for the structure, right? Then here, as price in this case moved up, right? So what I've done here is I've added another condor, right? So the original one was this one here, right? Then price moved up, so I then basically added one like this, right? The combined structure looks like this. So we went from 250 through to 270 now for our profit tent, okay? And now when things keep going, I did it yet again, right? And now you can see that our profit tent here is now 335 points, okay? So by doing this concept of price layering, we can extend our profit tent, the width of it, which is nice, okay? And then when things come down, and notice that I've been keeping my deltas negative all the way, right? And then whenever we hit resistance and this thing decides to come back down, then remember, this starts getting higher and higher, right? This is what I was referring through to the concept of time layering, right? So if you've not seen this before, you can actually, in Thinkorswim, set it up so that you can see multiple expirations, right, that you may be looking at. So, and you can see there, I know it kind of looks a bit messy, right? But this magenta line is the T0, but all of the other lines that you see there are essentially the expiration lines of the different expirations. So you can see that I've got a wide coverage, right? And again, this line kind of keeps getting higher and higher as Charm does its thing. Okay, one of the final concepts here is the concept of harvesting. So with this, the graph that you would have seen a billion times in every options theory book is that decay looks something like that, right? So if we're basically looking at your premium, so this is your expirations, right? So yeah, this is 0, right? This is 30 days, this is 60 days, and so on, right? So you get fast decay as you're running out of time, okay? What most options theory books don't tell you about, though, is that is at the money decay. Out of the money decay looks completely different, right? So out of the money decay actually looks like this, okay? And for those of you who haven't seen that before, that should surprise the heck out of you, right? It's like, what? It's almost the opposite, right? So in other words, this here is 0. So this is 30 days, this is 60 days, and so on, right? So simply by eyeballing this, what you can see is that when you get through to the final, now from a height perspective, right? If you get, roughly speaking, through to the final 20% of the premium, so in other words, this axis here is premium, right? So you start off selling this thing for $1, right? As this thing decays, as this thing gets through to, roughly speaking, 20 cents, so in other words, after it's decayed 80% down, the decay rate slows down massively. Okay, so you're not getting the theta that you expect to get. Not only that, you're carrying the same amount of risk, right? So if you've got that put credit spread that's 25 points wide, you're carrying that risk. This is, on a Reg T perspective anyway, that's the risk that you're actually taking, right? But you're thinking that you're getting theta. The software's telling you the theta should be there, but it's not coming into your account. Why? Because of this. Because the way it actually works is that decay for out-of-the-money options slows down massively at the end, during the final roughly 20%. Okay? So when you get that slowdown, if you know that this is going to happen, why not just get rid of it? Right? Why carry the full risk for 30 days for only the final 20%? If you've got this stuff relatively quickly and you're going to get this stuff like at a snail pace, then just get rid of it. Okay? So that's the concept of at the money versus out of the money decay. So what happens is you end up with graphs that looks like this towards the end. Right? Now, what the heck is this? And it looks beautiful, right? Because you go, oh my gosh, no risk. Notice that this thing is above 0, right? It's in profit in this simulation. Our 0 line is down here. So you go, how could you possibly do that? Well, what's happened in this case is that this was one condor. This was another condor. Okay? Then what happened is that the back wing decayed to a point that it wasn't worth keeping on. So I got rid of it. What does getting rid of it mean? It means that it decayed roughly 80%, right? So it went from $1 down to 20 cents or less, right? And then I say, fine, take this thing off. When you take the back wing off, you're then left with a scenario like this. Okay? So now, of course, if you're in profit, that means that you had a profit hump at some point and price came down into it, right? Otherwise, you wouldn't be in profit. So you're basically at that particular point. But then what you're doing is that once the back wing has decayed sufficiently such that you know that the decay rate is going to slow down massively, just get rid of the damn thing. And now what that leaves you with is a locked-in profit and a beautiful free in quotes, right? Basically paid for with the market's money, right? You personally now have no risk. The worst you can do is pocketing $1,000 at this point. For how long? For the next 17 days. Okay? And there's another example here, similar, right? So you can see this would have been one condor, then we would have another condor, and then another condor, right? And then we got rid of that wing, got rid of that wing, got rid of that wing, right? Still end up with some degree of profit, not huge, but some, but a beautiful paid for downside hedge, all right, with significant size, okay? Hedging your at-the-money structures.
So are you basically closing the put credit spreads but keeping the put debit spreads open?
Yes, exactly.
They act as a hedge.
Right.
Whatever else you have going on.
Right. And this is another reason why we wanted to split those wings out to allow the put credit spreads to decay more quickly by being further away from the money.
Yes.
Right? All right. So in terms of getting out, remember this thing is a downside hedge, right? So some people ask me, hey, what's your profit target? Well, a hedge doesn't have a profit target. It's a hedge, right? So it's not an income trade. So therefore, the correct answer would be it depends. It depends on, you want to structure these things so that they're hedging your at-the-money structures, okay? So you take it off whenever you feel that you've got a profit that you're happy with, right? I know that sounds generic, but for a hedge, that's the way it works. How can you take profits? You can close some or all of the tranches, or you could also peel off your, what I like to do is basically, when my back put credit spreads decay sufficiently, I get rid of those and I'm left essentially with paid for put debit spreads like you've seen in the last two screenshots. Okay? And a conservative exit is that if you've got that kind of structure, if price is here, if price comes down, remember you'll typically have profit humps, right? But if price comes here and gets into your structure or close to your structure, depending on your degree of comfortableness with that. But for me, if this happens, I'm out. At a minimum, I'm taking those profits, I'm peeling this thing off, and then I roll it back. Okay? Just to keep it safe. All right, so information very quickly on the paid course. I've got a video that goes into all the details here, right? But basically, if you go through to tradingdominion.com, you'll see this page, click on Learn More, and that will take you to a page that will tell you all about it if you want to learn this stuff, right? But again, Foundations goes through tons of different topics on everything from skew to decay through to portfolio margin, how to leverage it, right? A whole pile of different topics. Space Trip Trade, we've got 6 Space Trip Trade variations here. Black Swan hedges, we've got 4 Black Swan hedge variations and financing options there. And then we've got a final module that tells you how to blend all these things together, right? And by blending it together, we end up, the ideal of what we're looking at is this, all right? So basically this is, I've kind of hidden away all of the expiration lines and so forth. This is your T0. The whole concept is to be able to scale with a line that looks like this, no matter how much you scale up, right? So that your Black Swan hedges, which are somewhere over here, are hooking this thing up. Your STTs are providing a downside profit hump, and the 6 variations you'll learn in the course can actually be leveraged as income trades, not as hedges, right? So therefore, this line actually doesn't show locked-in profits. So as a matter of fact, this line is higher if you look at this, right? But this is the ideal of what I strive to do, right? I do not want a lot of downside risk. Yes, I am looking at things from a T0 perspective, but that's, in my opinion, how you have to manage portfolio margin. You have to, of course, watch it, but you want to keep your positions balanced so that you can keep scaling up in size with a T0 that is, in my opinion, very conservative, right? And then you might say, well, what happens on an IV spike? Well, on an IV spike, the Black Swan hedges that are here do beautiful things, okay? And that's the type of thing that I want. I want to know that I can go to sleep, and if the market, if Trump presses the nuclear button and blows up Iran or something insane, and the market freaks out, I want to know that I'm not going to lose my account. My objective is not to make a killing. My objective is to not lose money on a crash, all right? And the Black Swan hedge provides great, in my opinion, protection for exactly that. Whew, that was it. So fire away with questions if you like.
Well, first of all, tremendous job. We're over time here, but why don't we take a couple questions?
Sure.
And the rest of them, do you have some kind of a comment section or contact us section on your website, Ron?
Yeah, absolutely. Just go to tradingdominion.com, go to contact us or the help desk, and I'll be happy to answer that way.
Yeah, so if we can't get through all the questions tonight, which we're not going to be able to most likely, then they can ask the questions directly on your site. All right. So first of all, got Alex Porcaro, who trades for us, says very clear presentation. You can tell he's an Aussie. So, okay, Andrew, who also trades for us and does a lot of other things for us, do you stress test for some maximum amount of exposure on a 30 to 50% crash? Absolutely.
So, all right, the way that I like to balance my portfolio is more or less almost exactly what I've showed you here. Now, right now, I'm overhedged, right? So why am I overhedged? Well, because IV is so damn cheap, okay? When IV got to 10.6 or something insane, I said, well, that's, that's good for me. I'm loading up on these guys, right? So I overhedged by buying additional Black Swan hedges because I know that I'm going to be able to leverage them. I can either finance them to pay off the starting debit and essentially turn them into free, in quotes, Black Swan hedges, or I can basically use them to layer in through to more STTs that I would layer in through to here, and they provide protection for that later on. So once we get a bit of a pullback, I can either scale in through to additional STTs, or I can finance my Black Swan hedges, right? But the way that I balance it, personally, normally this line does tend to drip a little bit more for me, but what I do is more or less what I just showed here. So I keep my portfolio balanced such that I increase my IV by 10 to 15 points, and I want this line to roughly be like that. So in other words, with a 10-point IV increase, I want my portfolio to essentially be flat, Because again, my objective is simply to not lose money, not to make a killing, right? Not greedy. So that is, and I absolutely manage my entire portfolio. And I think that if you're using portfolio margin and you're not keeping a very close eye on your entire portfolio, not managing it one trade at a time, but your whole portfolio, I honestly don't think you're doing it right. Right? You have to look at the entire thing, because that's what the broker's looking at. Right? You could have a huge sea of death here that you don't realize you've got, and your portfolio margin starts to increase. Right? If you're not looking at your overall portfolio T0, you don't know that. Right? Your trades may look perfectly fine. There may be some kind of error. You may have a simulation that's not truly representative of what position you actually have on. Right? It could be a mistake. A whole variety of things. So you must look at your entire T0. But for me, if I bump this thing up by 10 to 15 points right now, again, it looks like this because I'm over hedged right now. But normally I like to keep it, again, to be something like that, so that it's with a 10-point increase, it's flat to the downside, no matter how far down you go. And if IV goes up by more than 10 to 15 points, well, guess what? This line just gets steeper to the downside. So if the market crashes by 50%, I'm actually a pretty happy man.
Very interesting. We're getting lots of comments. People really are deeply appreciating this presentation. Someone's asking for your email. I can type it in, Ron, if you just give it to me right now.
Sure, it's
type
just...
it in chat.
Yeah. Okay. It's just ron@tradingdominion.com. So.
Ron at tradingdominion.com.
Yeah.
Okay, so that just went out. Anyone who wants to look in the chat, you will see Ron's email address. Well, it looks like actually folks are probably going to reserve most of their questions for when they go onto your site, and it's also a testament to how clear of a presentation it was. I'm getting some really great comments in here. Okay, why don't we take one more question? How can this be used with the Reg T account?
Right, to do this on Reg T, and I've got a bunch of my members that do exactly that, right? You have to look at span margin, right? Because if you have Reg T, you don't have access to portfolio margin, but if your account is enabled to trade futures options, right, then you can leverage span margin. Now, span margin is not the exact same thing as portfolio margin. As a matter of fact, in a lot of instances, from a margin perspective, it could actually be better, right? So it's not uncommon to see better margin from a leverage perspective on ES than you'll get on PM, as in on SPX, right? The flip side of that, though, is that since ES is half the size of SPX, then you're essentially paying double the commissions, right? Now, the other thing is that interactive brokers have commissions for futures options that are quite reasonable, as in comparable through to what you would pay for an SPX option, whereas TD Ameritrade is not, right? So they charge a fair bit more for futures options commissions than interactive brokers. So if you have a Reg T account and you want to do these styles of trades, then the best thing for you to do would be to, in my opinion, go to interactive brokers, sign up with them, get approved for futures options with your Reg T account, and trade ES.
We're getting another comment. Ron, try to have him return to talk about the spaceship trade, the space trip trade for income, the non-hedged version. So,
right. Well, sure. Let me tell you about that. That's in there, right? That's in the paid course. So I show you 6 different versions of income space trip trades in the course.
You had a plant in the audience, Ron. So, okay, great. Ron, fantastic presentation. I can't remember the last time we got so many positive comments about a presentation.
Great.
Someone said it's greatest OptionsTribe meeting ever. So that's pretty good. That's pretty good because we've been doing this for pushing 6 years now, starting in May.
Great.
So great job, Ron, and I do want to have you back anytime you would like to come because it's such a clear. You're a very, very good educator, and we appreciate that very much on the OptionsTribe. By the way, because of Ron's presentation, he has now automatically for the next year is a free member of the OptionsTribe, and And I would like to, I'm saying that to try to remind people that if you do presentations on the OptionsTribe, you get to be a free member for a year, and that's pretty good savings. So please consider doing that. My favorite meetings are when our members present something that they've learned, something that they've developed for themselves. So please come forth with some ideas on that, and I always accommodate those. Ron, on behalf of everyone in the OptionsTribe, I want to thank you for a spectacular presentation. You put me to shame with your graphics, but even more with your brilliant options concept. So thank you very much. We'll talk offline about you coming back to present some other stuff when you rest up from this. And thank you again, Ron.
All right.
So,
thanks a lot, Seth.
My pleasure. Talk to you soon. Goodbye, everybody. Have a great week trading.